away from his live radio show that's going on at this hour, the Peter Schiff Show. Peter Schiff, CEO of Euro Pacific Capital, author of the book How an Economy Grows and Why It Crashes. What should the government do, Peter? I think I probably know your answer.
Well, the first thing they should do is stop destroying the jobs that we already have. You know, the biggest impediment to job creation is the government itself. And one of the reasons that so many jobs are being lost is because of all the litigation that is the result of regulation, of lawsuits filed against employers that are based on government regulations, and all the payroll taxes and all the things the government is doing. And of course, by borrowing so much money, by running these huge deficits, the government is depriving businesses of the capital that would otherwise be available to expand and hire people.
But you want to, and to separate talking about the government and what might happen with fiscal policy from another part of the government, and that being the Federal Reserve that deals with monetary policy, you wonder whether the reaction to a brutal report today, only 17,000 private sector jobs added, and net no jobs the month, whether we're going to see more monetary action, more printing of money, more quantitative
unfortunately,
easing.
We're going to. But, if printing money created jobs, we would already be at full employment. The fact of the matter is it doesn't work. The more cheap we have, the more capital is going to be destroyed. The more money is going to flee the U.S. economy. So what we actually need is higher interest rates. We're not going to restructure the economy until we restore sound money.
But
and
you
so
know,
as long
and
as the
I know
Fed
there's
is
no way
pouring
that's
gasoline
happening
on a fire, you can't expect it to go out. It's going to get bigger and bigger. And this is not about returning to recession. This is about the fact that we are already in the early stages of a depression.
Well, I know you've been on that course or making that case for many years now. And what we see here, as we look at unemployment under President Obama, something we'll talk about throughout the hour, what we see here in the market today is not only a sell-off in stocks, but I have to get your take on what we're seeing in gold. The price of gold is up almost $50 today, and I'm sure you're one of these people that think it's going to who knows how high.
Yeah, well, not only is it now $20 from a new record high, but more importantly, look at the index of gold stocks, the HUI, the HUI. That index today is at an all-time record high. And what's unique about what's happening now, and I've been trading gold and gold stocks for a long time, this is the first time that I can remember that following a correction, the gold stocks were leading the way, and that gold stocks made a new high before gold itself. What I think this indicates is not the bursting of a bubble like Dennis talking about, but a brand new phase of the bull market that's going to be even more explosive than the last one, because the public is finally accepting the rise in gold and they're willing to buy gold stocks. And I think this last correction, there was more fear in the gold stock market than greed. And that's the opposite of what you have in a bubble.
Watch what's going on in the gold market and have seen the run up and say, oh boy, I missed it. I could have had gold when it was well below $1,000, and here it is almost at $2,000, and you say it can go how high?
There's no ceiling. There's no floor on the dollar. I think at a minimum, I've had a price target of $5,000 an ounce on gold for many, many years. I still think it's going to get there. The question is, how much higher than $5,000 is it going to go? And that depends on how much money Ben Bernanke and his cohorts at the Fed are going to print. But who knows? I mean, it could go a lot higher than $5,000.
All right, enjoy the rest of your radio show. Thanks for taking a break to join us. Nice little studio setup you've got up there. We'll listen.